Welcome to this week's Market Update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets this past week. Despite some headline noise, the overall message from markets was one of relative resilience. The S&P 500 recovered from session lows of the week as progress on ceasefire discussions helped ease geopolitical concerns, although the situation still remains fragile. What's encouraging is that this wasn't just a technical bounce. It reflects genuine confidence among investors about the economic outlook. For our portfolios, this reinforces our strategy of maintaining exposure to high-quality companies, which have consistently demonstrated their ability to navigate short-term volatility, without losing sight of long-term value creation. Technology also played a supporting role this week, relatively speaking, as the Nasdaq 100 attempted to rally late with some positive momentum from the likes of IBM. Although volatile at times, this confirms that the best technology companies are real, cash-generating businesses with durable competitive advantages in AI and digital infrastructure. For our portfolios, this validates our conviction in holding high-quality companies, which continue to deliver the kind of consistent earnings that support long-term wealth creation. One of the most noteworthy developments this past week in the market was a deal in the clean energy space. Brookfield Renewable, alongside Lacasse, announced the acquisition of Boralex in a transaction that valued it at approximately $9 billion, marking one of the most significant renewable energy deals in recent Canadian history. The transaction comes at a meaningful premium to shareholders and is underpinned by long-term contracted revenues, giving us high confidence in the stability and growth potential for this platform. For our portfolios, this reinforces our view that renewable infrastructure remains one of the most compelling long-duration growth themes available to investors today, driven by electrification and rising energy demand. Now let's look at what specifically drove our performance this past week and why we remain confident in our positioning. ConocoPhillips was our top-performing holding this week, gaining just under 6% as energy markets rallied on higher crude prices and tightening global supply expectations. This is exactly the type of company we seek to own: financially strong, operationally disciplined, and positioned to generate returns both in strong and challenging market environments. The energy sector was naturally our top-performing sector again this past week, with ConocoPhillips leading and ExxonMobil close behind it at just over 4.5%. Tightening supply and resilient global demand are doing exactly what they should: lifting prices, improving earnings visibility, and enhancing the capital return potential of the companies we own in this space. Beyond near-term performance, we continue to see energy as an important strategic holding, offering both upside in strong commodity environments and a meaningful hedge against inflation in our portfolios. Our value strategy was the week's strongest quant contributor, with strength in energy and defensive sectors rewarding lower multiple, cash-generative businesses. This rotation towards value reflects broader investor preference for financial stability and earnings certainty during periods of macro uncertainty. We remain confident that owning high-quality, value companies alongside our growth companies creates the kind of balanced, resilient portfolios that delivers for clients across different market conditions. Looking ahead, here are the 3 key events that we're monitoring that could shape markets in the coming week. Tuesday brings the latest U.S. jobs opening report, with January's reading coming in just under 7 million job openings, beating expectations and suggesting that businesses remain in growth mode even as the overall pace of hiring does moderate. We'll be watching to see if that momentum holds, as a healthy job openings number supports consumer spending and reinforces the view that the economy is in a soft landing rather than stalling out. Wednesday's ISM Manufacturing Index will tell us how America's factories are performing heading into the second quarter. February's reading of 52.4 confirmed a second straight month of expansion, with new orders and production both holding firmly above 50. We'll be watching whether that momentum continues, as a healthy manufacturing sector broadly supports corporate earnings and adds to the case for continued equity resilience. The week's biggest event is Friday's monthly jobs report, which takes on added significance after February's unemployment rate edged up to 4.4%. Markets will be watching closely for signs of stabilization in hiring and wage growth, as a solid reading would reinforce confidence that the U.S. economy remains on solid footing. Strong employment data supports consumer spending, corporate profits, and ultimately the long-term potential of the companies we hold in our portfolios. Thank you for joining us, and we'll see you next week.